Reminding you again that we are recording these seminars and uploading them for people to look at afterwards. So if you want to be able to see these afterwards, or if you've missed any classes, you can check out our website and they'll be posted on there. And if you don't want anything that you say or anything to be in our seminar, just make sure you let Shaniqua know and we will make sure that we don't capture any of that. There's no video of you or anything, but sometimes voices get picked up. Anyway, let's recap a little bit what we talked about last time. So we just started getting into the idea of what happens after you've done a bit of your financial planning and after you've constructed your portfolio. Because like we talked about, it's not over, like the plan is not over. Things can change, things can shift around, and you need to make sure that you stay up to date on that. So we kind of broke that out into three categories. First of all, we're monitoring our portfolio. So that's important to make sure that everything within that stays in line. Make sure that your risk parameters are in line. If you're needing income, that we're doing that properly, and just everything else that we've talked about previously. Obviously, there's also your estate planning maintenance, making sure that cash is going to go where you want it to go. Assets are going to pass in an efficient way and to the place that you want them to be, and making sure that you're up on that. And also tax efficiency management, which we'll get into at a later time, but really just making sure that you're not throwing away extra money to the government. Once you get to distribution and spending, taxes are just kind of what's going to happen. You're not going to escape them at the end of the day, but there are more efficient ways that we can utilize assets. So last time we started talking about portfolio monitoring, really getting into what are the things that you can do after you're done with construction, after you're done with building a good, efficient, risk-aware portfolio. So really that's just making sure that we're still staying on those goals and objectives, understanding that it's still serving your purpose and how it's serving that purpose, and that staying within your risk tolerance and providing your cash needs. Because like I always talk about, the best plan is the one that you're actually going to follow. It's not about what the nominal returns are. It's not about any of that other stuff. It's really just about whether you're going to stick to the plan long term and stay the course. Because that's the main mistake that people make. And that's why there is the statistic out there that most investors do about 3% better returns on average with an advisor. And it's not because our returns are better. You could probably beat us with an S&P 500 index fund. But it's usually because we keep people staying the course the whole time and they don't pull away when things are risky. So we talked about all the lots of stuff that we like to do, that we encourage you to do if you're looking at a portfolio, making sure you're aware of current events, not allowing it to skew your perception of the markets and skew your perception of your plan, but really just a base level of awareness to know where we're at. Paying attention to changes in tax code and other laws, because that's usually where you're going to see the biggest impact to your plan. The performance and returns, all of that is sure one thing, but honestly, like if you lose a tax benefit, that's going to be pretty harmful to you. And if there's another tax benefit that you're not taking advantage of, like if we see, for example, that Social Security becomes non-taxable entirely, that's going to open up a little bit of, tax dollar spending that we can now use on something else. So it's important to be aware of what the opportunities are and which ones you gain and lose over time. Keeping an eye on the activities of the Fed always. I mean, for us, that's mostly looking at making sure that our portfolio isn't just way overexposed to interest rate risk. That's something that we always have preached against. I mean, we talk about shortening duration a lot, and I think that's just important to understand why. So making sure that you understand if we're at a point where interest rates are right near the bottom of the floor, that we're not, extending our interest rate risk out by a ton. And just paying attention to things like monetary easing or tightening. And then, of course, looking at your portfolio, of course, you can use stuff like Morningstar. That's what we like. Internally, I use white charts, but it can get a little expensive for an individual investor. But things like Google Finance, Yahoo Finance, and then for the most part, your broker-dealers will give you something that you can look through. So just using those analytical softwares to help you get a good idea of what you're looking at. And then, of course, looking at what's performing well, what's performing poorly, and not necessarily doing rebalances right now, but just kind of like understanding why. Like if you were holding on to a Dow Jones portfolio or Dow Jones index fund versus an S&P, you might have seen a bit of a performance discrepancy over the last couple days. And if you didn't know why, it might be kind of confusing and you wouldn't really have a lot of clarity. But if you look into it, you see that a company like United Healthcare took a bit of a nosedive right after earnings. So it's just kind of like understanding what's happening out there, understanding whether it's changing anything about your strategy or not, and not necessarily doing too many changes too quickly, but just a lot of awareness. And then stay educated. listen to podcasts, read articles, and just learn from reputable sources. I like Morningstar. I like Bloomberg. I like stuff from the big broker dealers like Schwab and Fidelity and all those other big names. Great sources. Just don't get too caught up in things that are lots of heat on the moment or lots of just excitement around things that are relatively minuscule in the grand scheme of things. Be really, really, really quick to zoom out and see the big picture and don't get stuck on the day. And then, of course, if you got the opportunity to go shopping, look at new funds, look at things that might do better for you. Lower cost as much as you can, because as I always say, fees are the #1 detractor of returns pretty much every time. Make sure you're getting same exposure for cheaper. That's always a good thing. And just bring the overall cost down of the portfolio. If your portfolio costs 1.5% versus 0.5%, that's a whole percent every single year that you're clawing back. So it's really important to get that cost as down as possible. Usually people won't get stuck in anything too ridiculous these days, but oftentimes if I bring people in, I'm taking them from a portfolio that costs maybe 0.5% to 0.75%, somewhere closer to like 0.1% or 0.2%. And that's just a little bit that we get to save and compensate for the fact that you're paying me some of that as well. And then also, something that's actually interesting to this last point, so see if old mutual funds are transitioning into ETFs and if that's suitable for you. Obviously, if you're sitting on a ton of capital gains, you don't really have a lot of movement available to you. But one thing I have been seeing recently is it seems like the SEC is starting to get friendly to the idea of funds actually having multiple classes, so having both ETF classes and mutual fund classes. So I'm curious if they would actually end up allowing some sort of swap there because you're staying with the same investment product. So I'm going to keep my eye on that. That might be something interesting going forward. Then, of course, as we move into sort of like a quarterly period, I want to dive into the metrics of the portfolio. I want to make sure that my risk metrics are on point, make sure my standard deviations where I want it to be, make sure my beta is where I want it to be, make sure my duration's where I want it to be, all the things that we talked about when we actually built a portfolio. Quarterly is when I want to make sure that they're staying relatively close. I'm not necessarily rebalancing every single quarter, but I'm just looking. I just want to check in and see what am I going to be looking for the next time I make a trade. So we're looking at objectives, risk tolerance, income, risk-adjusted returns, and obviously expense ratio, as I keep harping on over and over and over again. And then as we move to sort of biannually and annually, this is when I actually want to look to do trades. Unless I'm, trading towards a specific goal or I'm moving out of certain sectors, like this is where I'm actually going to look and see, is it time to do a rebalance? Or is any risk metric out of whack? Are we too extended on duration? Are we too extended on growth or any specific sector? This is when I really would be considering those trades. So if you've got a substantial increase in value in particular funds, especially like if you had some growth stocks that just been on an absolutely incredible run for the last 5 years, if that's tipping you off and a little bit strong on the standard deviation and beta risk, maybe it's time to trim back a little bit and move to somewhere else. So that's usually mostly relevant for specialty funds like concentrated growth funds or concentrated sectors, because if we're looking at total market funds, really diversified things, we're okay with letting that grow as long as it's not just completely throwing our risk tolerance out the window. But then after all of that, I think probably the most important, because most investment portfolios will do what you need them to do as long as they're not costing you 5% a year. Review yourself on an annual basis. Check in with yourself and make sure that you're being honest about whether your objectives, risk tolerance, liquidity needs are the same or different. And that goes both ways. That goes with admitting that you need more cash, you need less risk, or admitting that you don't really need to be distributing so much to yourself and you can actually allow yourself to take extra risk. Because I see that sometimes where you have just like these different mindsets when you're accumulating and you're trying to make sure that you're holding on to as much as possible. It feels like there's a lot of risk there. And then you get to a point where you're sitting on a giant pile of cash, but you won't let yourself do anything with it. Whether that means take on a little bit of risk, spend a little bit. It's just like making sure to check in with yourself and you're being honest and realistic, both for making sure that it lasts you and making sure that you actually use it. Because what was the point of making this big pile of cash if it doesn't get used for anything? So making sure you go through your sort of diagnostic checkups again, cash flow, insurance, estate planning, tax planning, all the basic stuff. just run through it again, just make sure everything's the same. And if it's not, make the changes you need to make. But today we'll start talking a little bit about the estate planning pieces. Just kind of like, we're not estate planning attorneys. I don't have all the advanced strategies that make everything perfect, but I just want to make sure you know how to check up on things and you understand sort of the basic terms and terminology and things that can help you at least get you a basic estate plan until you are able to put together your big grand plan with an attorney. So we'll talk about a couple account types, trust types, and a little bit of a estate planning checklist, which, in fact, we have handed out for you today. We have also an estate planning checklist here. So please just go ahead and run through this when you got some time. Make sure that you're doing some of these things and they're reminding you of where you should be. We've also got another handout about a couple things that you can do. This will have a lot of the stuff we'll talk about today. Most of the handouts do, but it's just good to take with you and review it just to make sure that you're sort of on the right track. So with that, what are we looking for when we're doing estate planning maintenance? Well, I want to make sure that, again, goals and objectives are going to be my two favorite words when it comes to every single category here. Are we doing what we want and what we need? Are we providing for our needs? Are we providing for the needs that we've stated, whether they're education needs, living expense needs, and so all different types of stuff? Are we accounting for family situations, whether that's simple ones or complex ones? Sometimes mixed families can get a little bit hairy when it comes to estate planning, so you want to make sure that you have things in place so that you don't have any situation where things can be contested. That's usually why we want to be specific is, if you have something like a mixed family, you don't want a situation where you have each of those families contesting for who gets part of the assets. It's not a super common scenario, but it's something to think about. So we're just going to start with some basic account types, just because I want to make sure that we know like where we're putting our assets and how they're going to function, because all of these different types of accounts have very different ways that they're going to function when it comes to passing assets to a beneficiary, or when it comes to tax-wise, all sorts of different things. So we're going to, let me just move this out of the way. Hold on. Okay. So first of all, we start with our super basic retail or individual account. It's exactly what you expect it is. It's an individual account, the name of one person on it, just one, and it just allows you to put money in there, buy and sell what you want. Think of it as a standard brokerage account with your name on it, or a checking account, something like that. And then we've got right below that, we've got our individual transfer on death. So it's really the same type of account as we have up here, but we're just adding on this other provision called transfer on death, which could also be called payable on death. So you'll either see TOD or POD depending where you are. Same thing, it's just kind of a different way that they refer to it. So the idea is you just designate someone, a beneficiary or multiple beneficiaries, and when you pass, that account gets moved right over to those beneficiaries, re-registered in their names, and they don't have any legal rights to the assets until the owner dies. So this is really this is like your step one of your estate plan, is if you don't have any sort of, if you don't have anything, if you're not directing anything anywhere, or all you have is a will, something really easy to do is just say, transfer this account to my beneficiary at death if you just have a spouse or a child or something. This is a really easy way, free, no cost. You just walk into your institution and say, can I put a payable on death to this person, please? And so that's a really easy way to go. Do we have a question back here? Right, correct. Yeah. Yeah, exactly. So if you have something like a trust account, then that'll take care of itself. But if you don't have, a trust or any of those sort of things, yes.
On death, that if you need those funds to help care for somebody, you can't access them with the power of attorney or anything because they're POD or.
I'm not sure that that's the case. No, because you should still be able to access it just like a regular individual account.
Trust the power of attorney.
Yeah.
That's all it gives you that.
Right. Yeah. That's only where that happens. It only transfers upon the death. And so it's not like some other type of account where it gets locked up for that person. It's still yours and fully yours, just like any regular individual account. It's just that when you do finally pass, then it transfers over to the beneficiary.
Put your house. It used to be that you didn't. You want to get a trust to make sure your beneficiary get it. But if you have one that you want to get it outright, you could do this until you get a trust.
Yeah. So then moving on to some of our, come on, We got a couple joint account types. We've got, let's see, we've got 4 that we're going to talk about, but we'll start here. The one that is the most common that I see most people have is joint tenancy with rights of survivorship, or JTWROS. So this is essentially, you got a joint account and there's no requirements of who, it can be any 2 owners, doesn't matter, but you got an account with what are called rights of survivorship. I'll explain that in a second. It's shared by 2 or more people who have equal rights to what's in the account. So if one person dies, the survivor will automatically receive the decedent's share of the account. So what that also means is that if you remember, assets that are inherited receive a step up in basis from whatever the cost basis is, right to the fair market value. With a joint tenants with rights of survivorship account, that half of the account that gets transferred over to the survivor, that gets a step up in basis, but only that half, right? So we'll talk about why that's important in just a second. But essentially, you just think of it as like, it's kind of like each of you own your like separate property, but it's just in one place, so that, let's say, this person is the beneficiary by just automatically, this person's the beneficiary automatically over this side. So when one person dies, it just goes straight there. So then you have next joint tenants in common. So this is a account shared by 2 or more individuals who have equal rights to the account again, except the difference is there's no rights of survivorship. There's no automatic transfer from one side to the other. It just goes right to that person's estate. So instead of you having the 2 people, one person dies and the other person inherits it automatically, instead it will just go back out to their estate and then be handled however it's mentioned in their will and trust and all that kind of stuff. So it's just, these are like the 2 common types of joint accounts. One that automatically the other owner receives the other half, one, the other half just goes to the estate instead. You know, I really have hardly ever seen a joint tenants in common ever used. Yeah.
How would you see properties for sale? Is that for like 200,000? Where are all that one tenant? Right? So they'll buy it in tenants in common. So if I die, my share goes to my family, not all the other investors.
Yeah, well, there you go. Exactly. See, that's why I keep him around. He's got all this information.
You own like 1/10.
Yeah.
You're sharing with the other family.
Yeah, right. You get it 2 weeks a year or something like that. Yeah,
Lovely.
but at least you own.
Yeah. Okay.
It's just a huge problem. We actually had a farm, and
Okay.
it split, and it was in community property.
Mm.
It's 50-50, and the issue was that my aunt passed. Who knows what she would do with that, and us making decisions, with her 50% could really screw it up. So that's when we went to LLC.
Yeah.
So they do exist out there.
Absolutely. The community property, if one dies, the other does inherit it and they get it tax free. But maybe that was tenants in common where she owned half and somebody else owned half.
Yeah.
Yeah, then that is the worry, because the problem with this place in Tahoe is somebody dies, they leave it to their teenage kid that parties a lot. Now all of a sudden you got a new partner and it's a big name. Yes.
Yeah. So then we've got 2 other types. We've got joint tenancy by the entirety and community property. And basically, these are kind of similar, except the difference is they're just offered in different states. So we've got community property here in California. I don't remember what the other states are that get community or joint tenancy by the entirety, but they're both for married couples only. So the first one, joint tenancy by the entirety, is a joint account reserved only for married couples in certain states that permits spouses to own property as a single legal entity. So each spouse will have an equal and undivided interest in the property. And this registration includes rights of survivorship. So it's kind of like your joint tenancy with rights of survivorship, but you consider it as the married couple, not 2 people together, but the married couple are the ones that own the property. Now, one thing that's pretty nice about this, if you're in a state that offers it, is that creditors can't enforce a lien on any property that falls under tenancy by the entirety if only one spouse owns the debt. So if you've got a nice little investment account that 2 spouses have put together and they're saving up for something, house, whatever the case may be, and then one spouse decides that they're going to have a midlife crisis and go buy a Porsche on a whole, ridiculously high interest rate loan, and then they can't pay it, that creditor can't come after the tenancy by entirety account, and that's actually protected because it's, kind of owned by that marriage as a different entity, and it's not considered separate property that can be gone after by a creditor. Now, In our state, in California, we've got community property. So that's a joint asset that was either acquired during marriage. So usually that's why, it's kind of, in California, we talk about planning before marriage, keeping separate property separate and all those sorts of conversations. Because if you don't make it very clear, it just kind of becomes community property sometimes. But essentially, it's a joint asset that was either acquired during marriage or re-registered to community property during marriage. So assets excluded from community property are separate assets brought into the marriage owned by spouses prior. So as long as they make sure it's very clear that they owned it before the marriage, or if they received an inheritance or a gift, that also is expected to be separate property unless commingled. Now, this is kind of one of the places that we see a lot of really easy estate planning switches to make is if we see somebody who has an account in joint tenancy with rights of survivorship with their spouse versus somebody who wants to have it in community property, because you'll get a tax benefit that I'll explain in a minute. Let's just go through two other account types really quickly first. So first, we've got our trust account, which is just kind of what you expect it to be. It's an account opened by the designated trustee of a funded trust, and it just lets you put money in there. It's just in the name of the trust, so it's just going to follow the instructions of the trust when they're in place. You're just putting your assets in there so that they get directed by the trust. Then you've got your custodial and guardian accounts. Usually for kids, that's the main place that you're going to see stuff like this, but it's just basically for people who they aren't able to manage their own assets due to age or incapacity or something like that. So usually you'll need a court-appointed fiduciary, but a lot of the times if it's a minor, it'll be the parent or something like that. They'll just appoint that person. But each state may have its own restrictions, such as certain types of investments and funds. So likely you're not going to be using speculative investments. We're probably not going to be doing options gambling or, spread trading futures or something ridiculous. It's just going to be sort of your standard, mutual funds, stocks, ETFs, and that sort of a thing. So let's go back to that community property registration, because there's one particular reason that we are always making a recommendation for spouses to switch from joint tenancy with rights of survivorship to community property, because they get a lot of the same benefits. Both in community property and joint tenancy, the surviving spouse will immediately inherit the assets, but the difference is with joint tenancy with rights of survivorship, only one half of the account gets that step-up in basis. So that can be sold at any point, no capital gains, assuming there's not any further earnings. But in community property, one thing that's really nice is the entirety of the account gets stepped up in basis. So only one owner, only one spouse dies, and immediately the entire property steps up. So the way that I kind of like to visualize that and explain it to people is it's like the marriage owns the account and the surviving spouse is inheriting the account from the marriage. So the entire amount of the asset gets stepped up. The basis gets all the way up to fair market value, no taxable gains, and we can move that around as we need to. So that's a really easy re-registration to do from joint tenancy to community property. Now, what's interesting is tenants by the entirety doesn't get the same tax benefit, even though it's functionally a very, very, very similar account. But for some reason, they don't get that same thing. And then obviously, inherited property is the other type of property that gets that sort of tax benefit, that step up, which is why I like to explain community property is owned by the marriage, inherited by the surviving spouse. It just kind of makes sense to me. So let's talk a little bit about types of trust accounts. We've got two main types of trusts. We've got your revocable trust and your irrevocable trust. Both of these will accomplish a similar thing, which is make sure that assets don't go through probate. And if you remember why we had that conversation, why we don't like probate, for a couple reasons. One, it takes a really long time. In California, I believe I remember looking it up, and the average was 12 to 18 months of time where assets are stuck in probate and they just will not get to where they need to go, versus even if we're just talking about a simple transfer on death, it's like a week maybe, or a couple of weeks where it gets re-registered, it gets to that beneficiary, versus going through probate, you're going to have a year or a year and a half of assets just stuck in their old registrations while the court figures out what to do. And that's not even all of it. Secondly, all of that information is completely public. So anybody can just take a look at where all of your assets go. And some people might think, well, I don't know, what's the big deal about that? But Sometimes you're going to have inheritance situations where not everybody gets the same piece of the pie, and people can get a little upset at that, or they think they deserve certain things, and it can just lead to extra family drama that doesn't really need to exist. So if we can just avoid that entirely, it's much better. Now that's 2 out of 3 things. The last one is that when they charge you fees to run assets through probate, this is really interesting to me, and I still don't understand why this is the case. They don't charge it on net assets, like after liabilities. They charge it on the whole of assets, gross assets, before they subtract mortgages or any debts out of that. They'll charge a percentage based on the gross assets, which is crazy to me, because there's obviously a giant chunk of that's going to be gone immediately to creditors, and you're charging me a fee on that? So I would rather pay the estate planning attorney ahead of time, get that out of the way, and then let it all go to plan. So the one place where they are really going to, in that sort of top line that I have up here, neither of them go through probate, but one of them will stay in the estate, one of them will be not in the estate. For most of us, that's almost not really a concern, because what we're talking about when we say in the estate versus out of the estate is usually what we're referring to is estate taxes. So because right now we get this giant estate tax exemption, this lifetime exemption of $13 to $14 million, where if you have that big of an estate, it can pass to your heirs and you won't pay estate taxes, it's not really that much of a concern. But let's just pretend, for example, that that didn't exist right now. So if you still had a ton of money in your estate and then you were going to leave it to a beneficiary and it had to move from your estate over, there's going to be plenty of estate taxes that you pay on that just for that transfer if there's no exemption. So we want to get things out of the estate before we pass, so we're not paying that tax on it. Now, again, it's not really that much of a concern for us, because I doubt that very much of us are sitting on $20 million of investment assets. And I imagine you'd probably be talking to somebody at Morgan Stanley instead of taking this class right now. So I would imagine that you'd be a little bit more set up, But anyway, as we move on, revocable trusts are really easy to modify, because essentially you still are the owner of the assets in a lot of ways. It's just kind of more of an organizational thing. So revocable trusts are great because they're easy to set up. It's easy to just kind of retitle things in there, and you can still take and give assets as you please. There's no problem there. There's no restriction. You can just go in and out whenever you want. Not a problem. With an irrevocable trust, because the point is to get the asset out of your estate, out of your control, they're more difficult to modify because they're just not meant to be. They're not meant to be touched and changed. The other reason why we want things in or out of the estate is because an asset outside of your estate can't be taken by a creditor or by a suitor. So if you got a lawsuit, if you got a big debt, they can't go after things in an irrevocable trust if it's clear that you don't have access or beneficial ownership over those funds. So that's why sometimes you also want to make sure you don't screw anything up with that irrevocable trust and then make it look like you actually do have access, because then they can take what they need to. So again, no access from creditors because they're not your assets anymore. You've given them up, and if the beneficiary is not you, it's somebody else, it's not for your benefit anymore. Those assets aren't held for you, they're held for somebody else. So then creditors aren't able to come after those again. Yeah.
So if you were to give your home, say,
Mhm.
you still live there?
Yeah, so you can do, there are some ways that some people will do that. Basically, you'll take sort of like a temporary benefit and you'll give the remainder benefit to somebody else. So like the remainder interest, like once you pass, the house goes to a child or goes to somebody else, but you can have that use benefit while you're alive. And it's like, it's not necessarily still your asset if you aren't going to get the beneficial, like you're not going to be the ultimate beneficiary at the end, right? Something like that?
Yeah. Like,
Right, exactly.
you give up the control and ownership of it, but part of the deal is you get to live there. But that's a benefit, so you gotta make sure the trust belongs. Also on the estate tax, we all laugh about, I'm not gonna pay any estate taxes over 12.5 million or so. But what if I live in another state where they have estate taxes over 500 or 1 million? So that's a thing. And then the stepped up basis that you get is at the time of death. So you inherit and that goes up from there, you got taxes.
Yeah, speaking of which, a little thing that we used on a client a little while ago is there are actually 2 different dates that you can get a step up in basis to. There's the date of death, but then there's another one that people don't usually think of very much, and it's called the alternate valuation date. And so that is 6 months following the date of death. So if there is a significant increase in asset values within 6 months after the passing, you can actually use that later date as your step-up basis, and you can include that gain as well. Now, one thing that's really important to understand is you don't get to pick and choose which assets get this treatment. So if some assets fall in value, too bad. If you want to elect the alternate valuation date, every single property has to be stepped up to that new date's fair market value rather than the date of death. So, well, the reason that it's significant is because, I mean, I'll just talk about a situation that we had where we had a client come in and they inherited a bunch of assets, and we were just kind of looking around. We noticed their real estate appreciated a lot since the date of death. Like, they actually had a pretty decent amount of appreciation there. Their stocks had also gone up a decent amount, because I think this was like, I think decently into 2024. So then, you know, we still had a decent bull market after that. So there was that additional gain that if they had just used the date of death for the assets, their basis would have been down here. Then if we need to sell and reallocate, all of this taxable gain is still built in, and we still have to pay for that. Versus we elect the 6-month alternate valuation date, and the basis steps all the way up to that fair market value. So then we don't have any taxable gains selling at this point. So it's kind of, it's just mostly beneficial for when you're going to do sales and things like that, and you get to include a little bit more gain. Yes.
On the irrevocable. It's not, it's bringing.
Mm-hmm. Yeah. Right. Yeah.
They have full use as trustees, co-trustees of it. That is one of the reasons why, so they can't be talked into giving things away and
Right.
doing things.
Mm-hmm.
Yeah, that was a durable power of attorney and a trust, but
And the
they,
springing one,
yeah, the spring
things
force
like
on
that.
Mhm. Right. Correct.
What you can do that on set up basis.
Yeah, there is a time limit. I forget exactly what it is. I don't remember if it's like the year of
Yes,
the
it's-
death. Yeah.
About that is, as Nash was working on it, the accountant didn't have a clue. Right? Then you have to talk to the accountant and educate that person.
Yeah, we did have to actually explain to them what the alternate valuation date was, which was,
Yeah,
you know, kind of interesting.
They don't use it very often, so that's fine. That's why you do financial planning, but he had to step in and talk to the accountant and explain it, because they were just gonna take one figure versus the better one. And so that's where the benefit of having somebody fighting for you to keep that up.
I don't remember exactly what the time limit is on that, but I'm going to find out. But yeah, it's probably going to be within the year of the date of death, I imagine. So there's a couple trust-related terms that we'll want to talk about. Now that we understand the two main types of trusts, there's just a couple things that's important to just understand what they mean. So you've got your grantor, beneficiary, and your trustee. A couple of these words we've already used a couple times, but grantor is essentially, if it's your trust, you're the grantor. You're the person who made it, you're the person who funded it, that sort of thing. Then you've got your beneficiary. So that could be either somebody who's receiving income from the trust. So it could be somebody who receives the assets at the termination of the trust. Could be somebody who's getting use benefit for the property inside the trust. A multitude of things. If they're receiving a benefit, they're a beneficiary, whether it's income, remainder, whatever the case may be. So they're just receiving benefits. Then you've got your trustee, and that's a person or company that manages the trust in accordance with the trust terms. Their whole job is to follow what the rules in the trust say. That's everything that they're meant to do. They're meant to just make sure that they distribute assets in the proper way, that whatever rules are followed, and that things happen as they're meant to. A lot of people will end up making family members and things trustees of their trusts. Now, if you really feel like you can trust that person to be, you know, impartial and make decisions, that's fine. And we talk about this with power of attorney and medical power of attorney and stuff like that too. But, you know, oftentimes it can be kind of tough if the person that you're trusting to manage the distribution of your assets is somebody who has a really heavy emotional investment in everything that's going on. Because, you know, as smart as people can be and as much as we can trust them, you know, emotions can make people make a lot of different types of decisions. So it's really important that, you know, if you're going to give somebody the power of a trustee or a power of attorney in whatever type of way, that you really, really understand why you trust that they're going to make the right decisions in the places that you're giving them power. So just really think about who you give these designations to. Really important. Yes, yes, they absolutely can, of course. And why would be a reason that you wouldn't want to do that? Make the beneficiary the trustee.
If you got sued and you're also the trustee, there's not an arm's length transaction.
That's what it is. Yeah, and that's kind of one of those things where we talk about, if you hear about like arm's length transaction, to make sure you're just kind of a step away from the assets of the trust, that makes sure that you, like something you do doesn't make you liable for paying from the trust. So that's why we wouldn't want to have, if that's going to be a concern, that's why we wouldn't want to have a beneficiary as a trustee, because then they're the ones getting the ultimate benefit and they're the trustee, so they have power over the assets. So it's like, it's not really anybody else's money anymore. It's just that person's asset at that point, and it becomes vulnerable.
That beneficiary is the trustee to control it. Now those assets are vulnerable, right? But if they're not the trustee, just the beneficiary, and the trustee can cut off anything to protect the assets in the trust if the beneficiary gets sued. If they distribute income to the beneficiary, the people suing you can take the income that they can't touch the trust. So you want that arm's length transaction if you want to protect.
Exactly. So now let's talk about a couple special types of trust. So obviously, a trust is just kind of a framework for constructing a nice strategy and all this sort of things, but there are some particular types of trust that we'll use for certain situations that just kind of like, they've been regularly used for a lot of reasons. So first of all, we've got our charitable trusts. If you're charitably inclined, there's a couple different things that you can do in order to get some current tax benefits while still building it into your estate plan. So first, you've got your charitable lead trust, which means that you're putting aside a specific set of assets that are directed to a chosen charity for a set period of time. And then once that once the term of that trust ends, those assets will come back to you. So usually that charity is using the income or things like that from the assets before they come back. And then you'll have a charitable remainder trust. This one's going to be a bit more common and a bit easier to understand, because essentially what happens is you build your charitable remainder trust and you say, okay, I'm going to take this big pile of investment assets, I'm going to stick them in here. I want to keep the income from them, dividends, interest, whatever the case may be. I'm going to keep taking income from these assets. Then when I pass, you can go ahead and give the rest of the assets that are left to a charity. So there's like some specific percentage of assets or income plus principal that you can take out without it becoming like not quite the same charitable remainder trust, but you take out some certain amount of income or benefits over time. Then when you die, all of those assets go to the charity, and you'll actually get some upfront tax like charitable contribution benefits for creating and funding these trusts. I don't remember all the specifics of those, but it is kind of nice to be able to front load that into your estate plan if you expect to be decently generous at the end of it, or you just don't have a beneficiary to leave the principal to at the end of the term. Next, you'll have something like a generation skipping trust. So I don't see a whole lot of these around, to be honest, but it's the assets go to the trust upon death, the income is paid to the children, and then the assets pass to the grandchildren upon the children's death. So this is just in a place where if you want to see the assets stretch out for a little bit longer, you've got a particularly big pile of money that can pay a lot of income. If you're really wanting to make sure it gets to grandkids, this is the kind of trust that you would use, where it's kind of like that charitable remainder trust, but the remainder beneficiary instead of a charity is the grandchildren. So you plop it in the trust, the income goes to their parents, to your children, and then upon their death, so the assets go there upon your death, then they pay the income to the children or parents before their death, and then when they die, then the assets pass to the grandchildren. So there can be a couple of extra generation skipping taxes along with that, but the exemptions are the same as the estate tax exemption as well. So those numbers are really high, and most of us are not going to run into that problem unless they sunset down to like closer to 4, 5, 6 million. And then we've also got something called a grant or retain annuity trust, or a GRAT. There's a bunch of other different structures of this, but we'll just talk about this one. So basically, you take assets and you place them in the trust, and then the trust creates an annuity that pays back to the grantor until the specified term ends, and then the remaining assets transfer to the beneficiaries. Again, similar structure to a charitable remainder trust, where you put the assets in there, you take the income, and then it goes to the beneficiaries after that. But this one's based on an annuity. It's not just income from the assets. You actually kind of like write a little contract using life expectancy and all that kind of stuff to make sure you get lifetime income. And then you've got your irrevocable life insurance trusts. Again, because of the estate tax exemptions, we're not seeing a whole lot of these, but if you do have a situation where you have some state estate taxes and whatnot, this might be a little bit more relevant. But essentially, the idea of an irrevocable life insurance trust, or an ILIT as they're frequently called, is they're specifically used to hold life insurance proceeds. The trust will be both the owner and the beneficiary of the life insurance policy. And because we know that life insurance proceeds are tax-free, there's not going to be any taxes on those, so they'll hit into this trust. And then the idea is if we have a really big tax bill on the estate side where assets are moving back and forth, these proceeds are going to be used to pay for those taxes. So the cost is the premiums along the way, and then when they receive the tax-free proceeds, those then pay for the estate taxes. So it's kind of like, just paying a little bit of, estate tax insurance over time with a little bit of structuring.
We have to point out that this trust is not your living trust. This is money that you donate to the trust, and it's set up to buy life insurance. The beneficiaries of that trust own that cash, and they have to have the option to take the money out and spend it. You cannot mandate that if you set up this trust and you donate to it, they have to buy life insurance. Then you lose. You wink and a nod, put the money in, they buy the life insurance, but you can't mandate that because then that means you're controlling.
Yeah, and again, that ties back to that arm's length transaction idea, where if you're directing what's happening in the trust, it's not really irrevocable, is it? Like if you have control over exactly what happens inside, and it's not simply following instructions, and it's just something that's really for your benefit. I mean, come on, it's not your assets anymore. The point is to pay for estate taxes, because essentially instead of losing a whole bunch of value to that, you're just paying the premiums along the way, which are usually going to be a lot less than the ending value is. But again, if we don't really have a concern for estate taxes, then we're not really worried about it.
But soon, if this estate tax exclusion sunsets, that 12 million is going to drop to about 6.
Are we expecting that?
I don't know, but that's a
Been mentioned?
yeah. We don't talk about
Pulling numbers out the air.
Yeah, we don't know. So the other thing is, let's say it does drop automatically, or it drops. The extent, if I die, I can get away 12 point something. Is it 13?
Yeah.
If that drops down to 5, and if I have a $7 or $8 million estate, there's some of that that's going to be taxed. And the estate taxes are on the gross of the estate as well, and the gross of your retirement plan. So if I have $1 million in a retirement plan, that gets an estate tax, even though if I pull it out, I only get 600,000. So this is for when the estate tax exemption drops or when it was lower, but right now most people don't have it.
Yeah. So then another one of your special types of trusts that you're going to have is a special needs trust. So these become particularly relevant if you've got a beneficiary that receives government assistance, and we need to make sure that we're not messing with those benefits. We need to make sure that they keep a certain level of income so that they can still keep those. So basically the idea is, in order to not compromise those benefits, the care has to only pay for medical care or day-to-day needs. That's what the trust can pay for. So that means that we're not buying them a nice fancy car, we're not sending them on vacations, we're just paying for day-to-day stuff and medical care. That way they can still qualify for their special needs or disability or whatever the case may be from the government. So we're just making sure that we don't touch any of that, and then this will continue to pay for day-to-day needs, which is pretty helpful. Now, obviously they have to be it has to be demonstrable that they are actually disabled and that they get these benefits and whatnot. So just keep that in mind. Then we'll get to what becomes a very useful type of trust, which is a spendthrift trust. And this is essentially just a trust with a spendthrift provision. So a spendthrift provision, basically what the idea is, you get as specific as you want with the rules of the trust, and you make it very, very clear what has to happen for a beneficiary to receive assets. So they maintain full ownership of the assets upon the grantor's passing, which basically means that a lot of the times when somebody sets a trust up, the idea is all the assets go in there and then the trustee distributes them to instructions. And that's the termination of the trust. Versus with something like a spendthrift trust, the assets go in there and then they stay there, and the trust is distributing on some sort of schedule or some sort of requirements, or the trustee continues to manage the assets over time until we finally complete the term of the trust or all the assets have been distributed. So because the trust is retaining the full ownership, now there's a special clause that dictates exactly how and when beneficiaries can receive their portion of the assets. Think, you don't get this money till you get married, you don't get this money till you go to college, you only get to spend it on this, you only get to spend it on that. Super specific instructions, things that are just saying, really want to be particular about how and when you're allowed to receive and use your money, or you have to prove something. And you can get really specific. This is where you can go way above and beyond like whatever the law says, and you can just say what you want to have happen for that beneficiary to get their assets, no matter how particular you are. I mean, I don't see it all the time because a lot of people don't have very specific, they don't, exactly. They like to just allow it to pass. But you can definitely see it for things like I mentioned, education requirements or marriage requirements or stuff like that, as long as they want that control to pass beyond their death. Yes. Yeah, so you can have that within your trust, right? It's just kind of like a provision that you add.
Make sure that nobody messes with it. Because we have one client, her son is in and out of prison. And she wants him to benefit with income but doesn't want him to control it. So that spendthrift, and what happens is your trust says, okay, when I die, create a spendthrift trust for the benefit of this person who has a drug problem or whatever.
And who monitors?
A private trustee can hire somebody. Yeah, and they make like $100 and some an hour, but they'll manage it, follow the terms of it, and file with the state and make sure that this beneficiary doesn't get taken.
Exactly. So then we've also got testamentary trust, which is basically just a trust that gets established as specified in a will. So if you don't create a trust right now and you put it in your will, you can say, when I pass, make sure you put these assets into a trust. So that basically is just avoiding probate, but it's still included in the gross estate. It actually functions kind of like a revocable trust, but you just haven't put anything in there yet, and it moves in upon your death. So we've also got a bit of a checklist that we're going to look at here in a second. Yes, sure.
Give the trust to the daughter,
Mhm.
but if the daughter gets a divorce and he can say the husband doesn't get anything, can you set something up like that, even though it's communal property, what you said?
Okay, so here's the deal. One, if it were to stay in the trust, it's never going to be marital property. So if it stays detached like that, it's going to still be like this inherited asset, which first of all, if it's kept separate during the marriage, it still can't be taken in like divorce court. So if it's separate property, that's still going to be completely separate. And then if it stays in the trust, that's even better. So if you got like spendthrift provisions or whatever, if it's still separate in a trust outside of the marriage, that's not really going to be part of divorce court proceedings. So it's really just about keeping it as separate property. And that can both be either if she were to inherit it and make sure that it's accounted for in a separate place and it's very clear, then it won't be a part of marital property, or if it stays within a trust and it's just like, maybe it pays out only income over time or something like that. It's also going to be considered separate property.
Your trust would need to dictate, if I die, set up an irrevocable trust for my beneficiary. Here's what I want you to do for them. So it could turn into an irrevocable trust. If that's a concern, there's nothing wrong with that, right? Because you're providing everything that person needs. But if they did get married and then they got a little emotional with their spouse and then it didn't work out and they ended up putting the spouse's name on it, you can't go backwards. So it's a lot better to have say, when I die, set up an irrevocable trust for my beneficiary, give them money up front, but here's what I want to go there. And you're truly benefiting them more than giving them all the money, and maybe they make some mistakes.
Yeah, exactly. So you could consider something where you set up that irrevocable trust and you say, okay, for the life of my beneficiary or up until some certain age, provide an income benefit only. And then if you hit a milestone or something, maybe you say at this age now finally turn over all the assets or have it go to charity afterwards or whatever the case may be. But if you wanted to provide an income benefit Or you could say like a certain percentage of assets can be taken every year, but not further than that. So yeah, you can get pretty specific and make that work out for your use case for sure. So let's look at this estate planning checklist. This is something that I pulled from nerdwallet.com. So if you want to look this up, you can just look up the estate planning checklist on nerdwallet.com, and you can see all of this information there. But essentially, this just goes through all the steps that you want to make sure that you go through when you're setting up your estate plan or when you're checking on it. So obviously, you want to create an inventory. You want to know what you've got, where it is, what kind of registrations we're talking about, just what do we have going on with our assets. Then you want to make sure you're accounting for your family's needs, your family's. Are you funding education? Are you funding really whatever it is? Just make sure you're listing all of that so that we know how much assets are needed for each need. Make sure you establish your directives. So understand how to instruct what's going to happen with you physically, with your assets, with everything. We'll dive into that in a second. Review your beneficiaries. Make sure that things are going to go where you want them to go. You know, that the right people are getting the right assets. Pay attention to state estate tax laws. Like we mentioned, if a state has pretty heavy estate taxes, we might need to be taking a look at some planning there. Weigh the value of professional help. I always like to recommend at least book an hour with an estate planning attorney just to take a look. If you've got your estate plan put together, just say, can you look at this and see if there's any holes? Am I missing anything? It's always really beneficial to just have somebody to look at it, get that second set of eyes, or maybe even a third, fourth, or fifth, just to make sure that things are all right. You don't need to pay a giant several $1,000 fee. You can just get them to look at it for a couple hours. And then make sure that you plan to reassess. Just go back and check. If things change, just like with the portfolio, make sure that you understand what changed, how you're going to address it. So, first of all, make your inventory. We got both tangible and intangible assets. It's just like what it sounds like. The tangible assets are stuff you can put your hand on, stuff you can grab, anything physical like homes, land, other real estate, vehicles, cars, motorcycles, boats, collectibles, or really any of your other personal possessions that you could pick up and touch. And then your intangible assets, that's going to be all the stuff that's just numbers floating somewhere out in the ether on somebody's computer somewhere. Checking and savings accounts, CDs, stocks, bonds, mutual funds, life insurance policies, retirement plans like 401ks, 457s, 403bs, all that sort of fun stuff. HSAs, ownership shares in a business, all those sorts of things. Make sure you account for your family's needs. If you don't have a will, I really hope most of you do at this point, make sure you make one. There's ways you can make a will online, usually for very low cost, and sometimes even for basically free. So if that's not there, just get it done. Ensure you have enough life insurance if that's a concern. Usually this is for those younger, income earners where, especially if you've got maybe young parents, those are the type of people that definitely need term life insurance because we need to make sure that if an income is lost or, a parent is lost, one, that you're able to pay for the living needs until something else comes into effect and we can fill that gap back up. And also, it's just really important to pay for grieving time because a lot of the times that's not part of our plan, that's not part of our savings account. We're not planning for that. So if we have a nice big chunk of life insurance proceeds that are tax-free, that help us to get through that period and not drain the assets of the estate in the meantime, that's a really great benefit for us to have, especially for dual incomes. Like I mentioned, if you lose an income, it's really important to fill that back until something else can compensate for it. Really important for people who have dependent children. Also name a guardian for your children and a backup guardian just in case when you write your will, so you can make sure that we're sidestepping costly family court fights that could drain the assets. Again, even if this stuff doesn't apply to you, carry it forward to the next generation. Make sure they know this too. It's really, really important for them as well. A lot of these estate planning things can be really important for people that are in their 30s and 40s with families, and if they just haven't been thinking about this because they're just deep in, paying for living expenses and raising children, that they're not going to think about these things a lot of the time. So make sure they consider this. Establish your directives. Well, like we talked about, a trust might be appropriate for you. With that revocable living trust, you put your assets in there and select a trustee to manage the assets for your benefit and for that of your beneficiaries. If you become ill or incapacitated, the trustee can take over for you. Then upon your death, the trust assets will transfer to the beneficiaries, getting away from probate like we talked about that we want to make sure we avoid, which is the court process that may otherwise distribute your property in whatever way they deem appropriate. So that's the thing. Usually your will not be overridden by probate, but it's possible. If they really determine that something is not, if they really have to make a change, they have the power to do that in court, especially if, say, there's some sort of, ex-spouse thing with children and, maybe you weren't providing for the children in the way you should have been. They have some power to make decisions for you, and you just don't want that to happen. You want to have things pass in the way you want them to pass, most importantly. So even if it's just transfer on death, revocable trust, beneficiary designations on IRAs and life insurance policies, really make sure you're on that. Medical care directive is another important one. Really, we talked about this a little bit before, and so also with the power of attorney. So a medical care directive, also known as a living will, spells out your wishes for medical care if you become unable to make those decisions yourself. So you can give a trusted person medical power of attorney for your health care, giving that person the authority to make decisions if you can't. Sometimes they combine these two documents into an advanced healthcare directive, but just make sure that you have both of these needs met for. And again, a lot of people, when they create their trust, what will happen is, especially if you're creating a trust with a spouse, they'll create both a financial power of attorney and a medical care directive at the same time as the creation of the trust. So if you're not sure, check your trust documents. You've probably got it in there somewhere. Next, obviously, we talk about our durable financial power of attorney, which is just allowing somebody else to manage your financial affairs if you can't. So your designated agent, as specified in the document, can act on your behalf in legal and financial situations when you can't. This includes things like paying taxes and paying bills and managing and accessing some assets for you. Again, if you created a trust with a spouse, super likely that both of these documents are in there, but just take a look if you're unsure. You can also give a limited power of attorney. So there's a couple differences in power of attorney documents, and I'll just explain those really quickly before we get into a limited power of attorney. A regular power of attorney, you sign it into effect, you name a person, now it's in power and that person can act for you, and then it will cease upon the time that you become incapacitated. Then if you add the durable to the power of attorney, it continues through your incapacitation. So if you go into a coma, you're stuck in the hospital, they can keep managing your assets. Now, if you don't want them to have power until you become incapacitated, then you add something that's called springing or spring forward. So then that waits for a specified event. Usually, almost every single time, that event will be you becoming incapacitated and a doctor saying they can't manage their investment accounts anymore. And so then that will then kick that power of attorney into effect, and then the durableness will continue it through the incapacitation. Now, no power of attorney lasts through your death. That's not something that happens. That's what you need a trustee for. Now, a limited power of attorney is essentially looking at that and going, okay, maybe I don't want to let them just handle everything for me, but I know certain people who have really good special information or expertise, and they might be able to handle things more particularly. So a limited power of attorney can be useful if that idea is just kind of concerning. And it does exactly what it says. It limits the powers that representative gets. So you might have somebody to say, if you are closing on a home sale, there's some kind of transactions in progress, and you go, okay, just in case anything happens, I'm going to make sure I give this person the power to sign on those documents for me so that the sale can go through, and you don't come back out of the hospital and go, so did we sell the house? No, you weren't there. And then that kind of messes with things for you there. So you can do that, or you can have them be directed to sell like a specific stock or something, or manage a particular investment account. So if you want to sort of piecemeal give power like that, you can do that as well. So make sure you're careful about who has your power of attorney. They might actually have your financial well-being and your life in their hands if you give them the advanced medical directive. So you might want to assign medical and financial representation to different people, specifically if you know somebody has more expertise over one area or somebody knows you a little bit better than the other. Because again, like we talked about, it's a tough conversation, but when we're talking about medical power of attorney, not everybody is going to listen to your needs. Some people might be more selfish. Some people might want you to stay longer than you want to stay, and we've seen something like that where, we saw a client whose family didn't listen to what he said he wanted to have happen, and he got stuck here for a while, and his standard of living was much lower than it was before the incident, and they just wanted him to stay. They wanted to keep that person in their life, and he became really, really, really angry, and it was just not pretty. It was not pretty for anybody to watch. It was just like he knew what he wanted, and they just blatantly disrespected that in front of his face. And so that just created so much drama and so much pain through the rest of that interaction in their life that it can be really unfortunate when something like that happens. So just understanding to make sure you give that power to somebody who's going to respect what you want, whether it's to fight as long as possible or whatever the case may be. Just understanding that whoever you're giving it to is going to listen to what you truly want in your heart of hearts. Really important. And then, of course, give backups too, because not always will that person be available. And it's not just if you give power of attorney to somebody and they die at the same, they die right before you. But it's also, what if they're just on vacation at the wrong time? What if they're just not here? What if they're just not here to sign that thing or, do whatever it is you need them to do? So make sure you've got contingencies, whether it comes to beneficiaries, power of attorneys, all sorts of stuff. Make sure you got backups for those types of things. And then when it comes to beneficiaries, check your retirement accounts and your insurance accounts. Retirement plans and insurance products will pretty much always have beneficiary designations that you need to keep track of and update as needed. A lot of the times, if you've got something like a revocable trust or something like that, you can just put the trust as the beneficiary on the accounts. That's what I do a lot of the times for clients, is we'll just say, all right, put all the instructions in the trust over here, and then we're going to re-register what we can, make the trust the beneficiary of other accounts where we can as well, and then the trust will just handle all of that upon passing. Make sure the right people get your stuff. Sometimes people forget the beneficiaries they named on policies or accounts they established a long time ago, especially when it comes to old 401ks you're not thinking about, or really old, say, permanent life insurance policies that you're not proud you got sold on, like a whole life policy or a universal policy. We got to make sure that we check those beneficiary designations too. Crawl through those financial statements, crawl through those documents, and make sure they're going in the right place. And don't you dare leave those beneficiary sections blank. Make sure they're at least going somewhere. If it's just the trust, that's great. But we don't want to leave the beneficiary designations blank, because if that is the case, and there's no direction for where the assets are going to go, when they hit probate, who knows what beneficiaries are going to get those assets? Who knows what way they're going to get split? Who knows who's going to contest for receiving those assets? Who knows who's going to step out of the blue and be like, I really deserve that, and have a really good case, and then get your IRA. We want to make sure that that doesn't happen and that we have direction for assets. Again, name contingents. Make sure that we've got backup beneficiaries. They're super critical. If your primary beneficiary dies before you and you forget to update it, we go back to that situation where it's as if it was left blank. So make sure we're not leaving it blank. If you don't have a great idea of how you want to split things and you have a trust, just put the trust there, even if it's just temporary for now, because it's a great place for assets to fall into as a bucket. Make sure you're paying attention to the state's estate tax laws. At the federal level, only super large estates are subject to estate taxes. These numbers are a couple years outdated, but the federal estate tax ranges from rates of 18% to 40%. So that's higher than the highest ordinary income rate for an individual. That's why we want to make sure we don't pay estate taxes, because they're super, super high. But it really only applies to assets over $12.92 million in 2023 or $13.61 million in 2024, and marginally more than that in 2025, I imagine. So what if you have an estate that surpasses the federal limits? Well, you might want to consider something like a grant or retained annuity trust, which is what we talked about before, where you put all those assets in the irrevocable trust and then you get an annuity out of that. Some states will have estate taxes, so they might levy estate tax on estates valued way below the federal government's exemption amount. Like Bill was mentioning, some over $1 million are subject to estate taxes, some over $500,000, and some are really, really low. So it's important to understand what state we're in. California is super lenient. We don't have estate taxes like that, but you might have some states that have inheritance taxes, so beneficiaries out of state. Just check in and see how that's all going to play out. So if you've got a state with inheritance tax, the people who inherit the money may need to pay some taxes on it. Usually you'll get that step up, you'll always get that step up in basis, but you might get that inheritance tax. Yes.
That state.
That state, for the most part, that's my understanding.
So you have to know that, and then you file taxes with that state for that
Yes.
portion.
Yeah, and if you move out of state but still have rentals here and you sell them, you're gonna pay state tax, even though you're a resident of another state.
Because you live out of state.
Yeah, and I learned Nash did an analysis of my tax return, everything looked okay, but I was wondering why my refund check wasn't as much. My accountant CPA claimed that I did an IRA, which I didn't. I did a non-deductible IRA and then a Roth backdoor conversion, so that's why I didn't get as much back as I thought, because the government got it. But one thing I learned from the thing that we ran is that in California, I have an HSA, right? If I need a new tooth, I'll just use my HSA, got a deduction going in, it's tax-free coming out. Not in California. It's taxable, take money out of your health savings account. Federal, it's tax-free, but I had to pay tax on my dental work that I didn't even think of, but his analysis pointed that out at the bottom. So California's gonna do everything they can to hit you with the taxes. And like I said, if you move out of state, remember, in the old days, if you retired here but moved out of state, you still had to pay California state income tax on that pension. Then they passed a law and said, no, you don't. But they're trying to pass it again, saying, yes, you do. And in a way, it makes sense. You made the money here.
Yeah, exactly. So then we want to make sure that we're weighing the value of professional help. So if your estate's small and your wishes are simple, there's a lot of online stuff, packaged will writing programs that might be useful. So if you've got like, young people who just haven't really thought about this, get them to go online. You can find it. Maybe you can volunteer to pay for it for them. It shouldn't be very expensive, but just make sure people got it in place. Even if it's not very many assets, if you put it in place and it's nice and it covers everything, then it will be very helpful moving forward in case anything happens. So these programs will typically account for IRS and state-specific requirements, and will walk you through writing a will using an interview process about your life, finances, and bequests. You can even update your homemade will as necessary with a lot of these really easily. So there's not really much of an excuse to not have a basic estate plan and will. Make sure it happens for everybody. If you have doubts about the process, it might be worthwhile to consult an estate planning attorney and maybe even a tax advisor, so they can really help you figure out if you're on the proper estate planning path, especially if you live in a state with its own estate and inheritance taxes, or if you're dealing with some out-of-state stuff like we just mentioned. Really important that we consider everything in those things. For large and complex estates, special child care concerns, business issues, non-familial heirs, an estate attorney or tax professional will be super valuable, and I highly recommend to consult them. Even if you're just checking up on what you already did, like I mentioned, grab an hour or two with an attorney, have them look over the documents, and just have them point out any giant red flags. Really important for stuff like that. And then make sure you plan to reassess as much as you can. Revisit your estate plan when things change, for better or for worse. If you've got more assets, those need to be accounted for. If you've got less assets, we need to make sure that we're distributing in the right way. If you've got a marriage or a divorce or the birth of a child, the loss of a loved one, getting a new job, or being terminated from your current job, all of these things can be big changes. It's going to affect the portfolio, it's going to affect the estate plan, and it's probably going to affect the tax plan too. So it's really important to consider how each of these events change the estate plan and whether there might be something to change. Revisit your estate plan periodically, even if the circumstances don't change. This is what I talk about with the portfolio too. Even if it's not totally different, just revisit it, make sure you have tons of clarity, you understand exactly what's happening, and if somebody starts to grill you on your estate plan, you can answer every question like that. Really important. Although, and plus, your situation may not have changed, but maybe the laws did. Maybe we did lose a giant piece of that federal estate tax exemption. Maybe it goes all the way down to nothing. Maybe all estates are taxable. We don't know what can happen. Things can change really quickly. Obviously, we've seen evidence of that in the last couple months and weeks, and things move quickly. They move a lot sometimes. It will take effort to revise your plan, but just make sure that you're looking, and the need to revise means that you've already avoided the biggest estate planning mistake you could ever make, which is not having one. Not having one puts you back to everything that we talked about before. That's when we talk about going through probate, that public process, that 1 to 2 year process, that expensive process where they charge a percentage on the gross assets, not the net assets after liabilities. I would much rather pay a nice big flat fee to an attorney ahead of time than to know that my assets are just floating around in probate court for 2 years and they're not getting to where they need to go, especially if I know somebody's going to have an immediate need after my passing. So it's really important that we account for all of those different types of things. So, well, we still have 15 minutes, but that gets me through my slides today.